a deep dive into the core finance, right? So what we are actually doing right now is I am going to be like, giving some prompts to chat GPT, and we're gonna just like, study through it. The complex terms, say if you're interested in the core finance, we're gonna do that. All right. So let's just understand what is asset return volatility. So volatility refers to how much the price of an asset, like a stock, fluctuates over time. So high volatility means the price changes a lot, while low volatility means it stays relatively stable. Asset return is the profit or loss made from an investment in an asset over a period of time, often expressed as a percentage of the asset's initial price. Okay. Now, what is Brownian motion? Brownian motion is a mathematical model used to describe Brownian motion is a mathematical model used to describe random movements, often applied to a stock price in finance. It assumes that the price change a little bit at each movement in time, similar to how particles move randomly in a fluid. Okay. Now, jump process. A jump process is a model that allows for sudden or large changes in the price of an asset rather than just the small continuous changes described by Brownian motion. These jumps can represent unexpected events like market crashes or major news. European call options. European call option is a type of financial contract that gives the holder the right, but not the obligation, to buy an asset at a specific price on a specific future date. Unlike American options, which can be exercised at any time before expiration, European options can only be exercised at the expiration date. Now, Heston's stochastic volatility model. The Heston model is a popular way to model the changing volatility of an asset over time. Unlike simpler models that assume constant volatility, the Heston model allows volatility itself to fluctuate, providing a more realistic description of asset prices. It's okay. It's a bit like a complex one. Let's just go through that again. The Heston model is a popular way to model the changing volatility of an asset over time. Unlike simpler models that assume constant volatility, the Heston model allows volatility itself to fluctuate, providing a more realistic. Okay, all right. Hawkes process. Hawkes process is a type of mathematical model that describes events happening over time, where each event can increase the likelihood of more events happening shortly afterward. In finance, this can represent situations where a price jump makes further jumps more likely. Hawkes process is a type of mathematical model that describes events happening over time, where each event can increase the likelihood of more events happening shortly afterward. In finance, this can represent situations where a price jump makes further jumps more likely. All right, kernel function. A kernel function is a mathematical function that defines a relationship between events in a process. In the context of your model, it determines how much past jumps influence future jumps, essentially controlling the memory of the process. Fourier transform. A Fourier transform is a mathematical tool used to break down complex signals into simpler parts, often used to analyze functions that vary over time. In finance, it's useful for deriving prices of options when the underlying model is complex. Probability measure is a mathematical way to assign probabilities to different outcomes in a random process. In your model, different probability measures define how quickly or slowly the memory of past jumps fades. Stationary. It is a property of a process where the statistical characteristics like mean and variance do not change over time. In your model, stationarity ensures that the overall jump intensity remains stable and doesn't grow uncontrollably. Markov property. A process has the Markov property if the future behavior of the process only depends on its current state, not its past history. When your model loses the Markov property, it means that the process has memory where past events influence future outcomes. Characteristic function is a mathematical function that provides an alternative way to describe the distribution of a random variable. It's particularly useful in option pricing because it simplifies the calculations needed to determine the price of an option. Euro Stoxx 50. It is a stock market index made up of 50 of the largest companies in Europe. It's often used as a benchmark for European markets and is a data set you use to test your model. Memory kernel. In your model, it defines how the impact of a jump decays over time. Depending on the form of the kernel, example Laplace, Gaussian, logistic, Cauchy, the process remembers past jumps for different lengths of time, influencing future price movements. Laplace, Gaussian, logistic, Cauchy measures. Okay, Laplace memory fades quickly. These are like different types of probability distributions. That is how a process remembers past events. Okay, Laplace memory fades quickly. Okay. Gaussian memory fades more slowly in a bell-shaped curve. Logistic, similar to Gaussian, but with heavier tails. Slightly more extreme values. Okay. Cauchy, memory fades very slowly allowing for long lasting effects of past events. All right, so these are like, one of the difficult terms that you must be aware of. So we read about like, asset return volatility, Brownian motion, European call options, Heston's stochastic volatility model, Hawk's process, kernel function, Fourier transform, probability measure, stationarity, Markov property, characteristic function, Eurostox 50, memory kernel, Laplace, Gaussian, logistic, and Cauchy measure, which are actually the type of probability distributions. All right. So this was this, but exactly. So title is basically enhancing option pricing models by adding jump risk and memory. Okay, traditional models for predicting asset prices, like the Heston model, struggle to explain certain jumps in pricing patterns like heavy tails, Unix, and volatility clustering. To better capture these complexity, we suggest modifying the Heston model by adding a jump component influenced by past events, memory, and self-excitation, where past jumps can trigger future jumps. Key concepts: two sources of volatility, continuous part and jump part. The usual fluctuations in prices, modeled by Brownian motion like random small waves in a lake. Jump part, sudden large movements in prices modeled by a process that remembers past jumps. Memory and self excitation use a special type of a process called a Hawk's process, which means the jump in the price can lead to more jumps in the future. How long the price remembers these jumps is determined by a memory kernel, a function that decides how past jumps affect future jumps. Types of memory. We explore 4 different ways the market might remember past jumps. All these types of memory or probability distributions, we just Laplace, Gaussian, logistic, Cauchy. Pricing options: to calculate the price of a European call option, a financial contract that gives the right to buy an asset at a set price, we use a method involving Fourier transform, which is a mathematical tool to handle the complexities introduced by memory. Results: when tested on real market data, Eurostox 50 options, our enhanced model does a better job of matching actual prices than the original history model. This suggests that including memory and jump risk makes the model more realistic. All right, understood. Just a second, we are just jumping on to the next part. Okay. Hi guys, so this is the next complex thing that we are studying, and one of the most complex uh, most the complex terms that is given that you should understand here in this paragraph is what is the hard information. It refers to the quantifiable objective data that can be easily measured and verified. In the context of bankruptcy, this includes financial statements, credit scores, and other numerical data that provide a clear picture of a company's financial health. Soft information, it involves qualitative subjective data that is harder to measure and may include insights or opinions. In bankruptcy cases, soft information could come from textual analysis of legal documents, communications, and reports written by professionals involved in the process. Bankruptcy outcome. So, bankruptcy outcome refers to the final resolution of a bankruptcy case, such as whether a company is restructured, liquidated, or if its debts are renegotiated, right? So, in court procedures are legal processes that take place within the court system. In bankruptcy, these procedures involve formal processes like debt renegotiation, reorganization, or liquidation under the supervision of a judge. Causes of default. They are the reasons why a company fails to meet its financial obligations leading to bankruptcy. These could include poor management, economic downturns, or unexpected financial shocks. Identifying these causes is crucial in understanding the company's financial distress. Textual analysis. It is a method of analyzing written content to extract meaningful patterns of information. In this paper, it actually involves examining legal documents written by insolvency practitioners to identify soft information such as the underlying causes of the company's financial troubles. Insolvency practitioners, they're professionals who manage the bankruptcy process. They assess the financial situation, oversee the distribution of assets, and may write reports that include both hard and soft information about the case. Creditor's choice. It refers to the decisions made by creditors, those to whom the company owes money, regarding the outcome of the bankruptcy process. The decisions might include whether to support a reorganization plan or push for liquidation. Dataset of hard or soft information. The dataset in this paper includes both hard information like financial data and soft information like textual insights from legal documents for Italian SMEs, small and medium enterprises, that underwent bankruptcy proceedings between 2011 and 2016. Italian small and medium enterprises. SMEs are companies with a small to medium sized workforce and revenue. In this context, the paper examines the bankruptcy outcomes of Italian SMEs, which are an important part of the country's economy. Debt renegotiation. It is a process where a company in financial distress attempts to restructure its debts to avoid bankruptcy, often by extending payment terms, reducing the amount owed, or finding other ways to meet its obligations. Interaction between hard and soft information. The interaction between hard and soft information. The interaction between hard and soft information refers to how these two types of information work together to influence the decisions made by creditors. The paper suggests that while hard information is important in understanding, the soft information, like the reasons behind the company's failure, is also crucial in shaping the final bankruptcy outcome. So basically, this is like, just a second. I think my keyboard is doing a problem. Sorry guys, but I'm taking some small dinner break. I had a late lunch, but please give me 20 minutes. So, guys, I'm back, and this is studying about. Let me see. So this paper is kind of actually studying both hard and soft information determining the outcomes of in-court bankruptcy procedures. Specifically, it investigates how these two types of information influence the decisions made by creditors when a company is undergoing bankruptcy. Key objectives of the paper. So, understanding the role of hard information. The paper examines how hard information, quantifiable data like financial statements, traditionally influences the outcome of bankruptcy cases. Past research has focused heavily on this aspect, assuming it's the primary driver of decisions in bankruptcy proceedings, exploring the impact of soft information. The paper introduces soft information, qualitative insights such as the cause of a company's financial distress as an additional factor that could influence bankruptcy outcomes. This soft information is extracted from legal documents and reports written by insolvency practitioners during the bankruptcy process, testing the interaction between hard and soft information. The paper hypothesizes that soft information complements hard information. It suggests that the effectiveness of hard information in guiding creditors' decisions may depend on the specific causes of default identified through soft information. So, how the study is conducted, data selection. The researchers compile a unique data sets that includes both hard and soft information from Italian small and medium enterprises that underwent in-court debt renegotiation between 2011 and 2016. The data set is crucial for analyzing the interplay between two types of information. Textual analysis is done of the soft information. Then the hypothesis is being tested. The studies test whether soft information, such as the identified causes of a company's financial distress, influences how hard information impacts the decisions of creditors. The goal is to see if these two types of information work together to shape the final bankruptcy outcome. Empirical analysis. Using the collected data, the researchers conduct an empirical analysis to determine the relationship between the causes of default, soft information, the hard financial data, and the resulting bankruptcy outcomes. Conclusion. The study concludes that both hard and soft information play complementary roles in influencing bankruptcy outcomes. The interaction between the specific causes of default, soft information, and the quantifiable financial data, hard information, significantly impacts the decisions made by creditors, ultimately shaping the bankruptcy process's results. In summary, the paper provides evidence that understanding the qualitative aspects of a company's financial distress is as important as analyzing the hard financial numbers when it comes to making decisions in bankruptcy cases. All right, so we understand this, and now we are heading on to the next. What does it say? All right, on to the next financial terms we are going to study. Okay, so actually, the next thing that we are going to study, it actually has a full version available. So let's just go through it all and then decide. Okay, okay. Hmm, okay, okay. Okay, guys. So there is this kind of this study on pricing fluctuations. So the key points that were given here is the skewness in investments. So skewness refers to the asymmetry in the distribution of investment returns. A positively skewed distribution has a long right tail, indicating a small probability of large gains. A negatively skewed distribution has a long left tail, indicating a small probability of large losses. So experiment design. This study involved experiments where participants made investment choices based on different skewness levels in the distribution of returns. Participants generally preferred positively skewed distributions, meaning they were attracted to investments with a chance of large gains, even if the probability was low. Findings. The study found a correlation between skewness seeking behavior and speculative behavior. People who were more willing to take risks were more likely to prefer positively skewed investments. The results also showed that when people perceive positively skewed distributions as safer, they are more likely to choose them. Understanding skewness preferences can help in designing financial products that better align with investor behavior. The research suggests that financial markets may benefit from offering products that cater to different skewness preferences. So these were the kind of implications and findings that were given in this paper. But along the way, let me tell you what this was talking about in exact language. All right. So let me uh, just a second. Now, I'm sorry, I'm on my laptop and it's causing me a lot of problem in opening the documents, so that's why there was a delay. So it's basically it's a document where we are studying actually the skewness seeking behavior and financial investments. So it talks about recent theoretical and empirical advancements highlight the pivotal role played by higher order movements, such as skewness, in shaping financial decision making. Nevertheless, contemporary experimental research predominantly relies on limited outcome lotteries and oversimplified representation distant from real world investment dynamics. To bridge this research gap, we conducted rigorously pre-registered experiment. Our study delves into individuals' preference for investment opportunities, examining the influence of skewness of continuous probability distributions of returns. We document inclination towards positively skewed outcome distributions. Furthermore, we uncovered a substitution effect between risk appetite and the sign of skewness. Finally, we unveiled a robust positive correlation between skewness-seeking behavior and a propensity for speculative behavior. Simultaneously, a distinctive negative correlation surfaced between skewness-seeking behavior and the perceived risk associated with positive skewness. Now, introduction. Skewness is a measure of the symmetry of a distribution, such as the distribution of returns on an investment. While the literature has traditionally focused on the first two movements of the distribution, expected return and variance, higher order movements have increasingly been studied from multiple perspectives. Skewness, which is usually measured with the third standardized movement, had been indeed associated with several phenomena, effects, and anomalies, such as the long shot anomaly on the horse track. And in inline lotteries, inline lotteries, the volatility smile. Oh my god, my laptop. The preference for lottery-like stocks, the underperformance of IPOs, the underperformance of high skewness stocks, and the conglomerate discount. The common denominator of all these phenomena is that some individuals who find the combination of low probability and large outcomes very attractive overpay for access to these investment gambles, which as a result tend to yield lower returns. In this context, skewness preference is a concept used to refer to the preference for a positively skewed distribution of outcomes, that is, one with a long right tail over a negatively skewed one. All right, and what are we studying? Consulting representations. This was the skewness seeking behavior in financial investments. Like, how people are depending their, investment decisions on this by actually studying the probability distributions and the skewness seeking behavior of whatever the these returns are giving them, right? Now, this passage where we are studying about the certain representations of pricing functionals. What does this say? So it is basically providing us a revisit to two classical problems in the field of financial mathematics, specifically concerning option pricing. So here is a simplified breakdown. Pricing functional. Okay, so risk neutral measure and option prices. The first problem involves determining the distribution or law of the underlying asset using a risk neutral measure. This is based on the prices of options. The risk neutral measure is a theoretical probability measure where all assets grow at a risk free rate, and it's a key concept in option pricing models like the Black-Scholes model. Pricing of options with convex payoffs. The second problem deals with pricing of options that have convex payoffs, meaning the payoff curve bends upwards like call options. The goal is to express these prices in terms of the price of standard call options with the same expiration date. Inverse problems approach. Both problems are framed using concepts from inverse problems theory, and inverse problem is where you start with the results, like options prices, and work backwards to determine the cause, like the law of the underlying asset. General solutions. The solutions provided do not rely on specific assumptions about the distribution of the underlying asset. The generality may extend the current literature, offering more flexible results that can be applied to a wider range of situations. Related problem. Reconstruction of put option prices. The passage also mentions a related problem in non-parametric option pricing, which involves reconstructing put option prices. This is done through an approximation scheme where a sequence of measures, probability distributions, converges to the distribution of the underlying assets return at fixed maturity dates. So in essence, this passage is about refining and generalizing methods for determining asset distributions and pricing complex options, contributing to a deeper understanding of option pricing theory without relying on restrictive assumptions. All right, so that is what they were talking about, the pricing of these options, and how there are just these different ways, inverse problem approach, or general solutions, or pricing of options with convex payoffs, or risk neutral measure and options pricing. So that's the kind of approaches that they followed for pricing the options. So that's their view, and that's how they did it. So these are the kind of four different type of complex things that we studied right now, and I hope this has opened a little bit of complexity into the financial world of what is going on. Next, it's talking about So the next complex topic that we're going to study is about commodity cycles and financial instability in emerging economies. Okay. Okay, so this passage is delving into two foundational is delving into two foundational issues in the realm of financial mathematics, particularly in the concept of option pricing. Here's a concise explanation. Determining the distribution of the underlying asset, risk neutral measure. The first problem is about figuring out the distribution or law of the underlying asset under risk neutral. This is done through the option. A second. This is literally the same. Just a second. So basically, this thing is this. What is exactly commodity cycles and financial instability in emerging economies. So it actually says that this summary of this research is highlighting actually the aspect of how commodity price shocks influence the economy, particularly in Russia from 2001 to 2018, by employing a small open economy, new Keynesian model that accounts for endogenous default rates. The study shows that these defaults amplify the impact of commodity prices on GDP fluctuations. These defaults keep finding the amplification of commodity price impact, allowing for variable default rate significantly increases the contribution of commodity prices to GDP fluctuations from 2.5% to 33.6%. Wow. Effects on financial metrics. The effects on deposits and non-performing loans are even more pronounced, rising from 5.3% to 1.6% to 71.3% and 60.4% respectively. Wow. Demand and income effects. The model emphasizes the importance of demand and income effects over relative price effects, which are traditionally associated with other financial channels like country risk premiums and balance sheet constraints. This approach shed light on the dynamic relationship between commodity prices and economic health in commodity exporting countries, suggesting that policymakers should consider the role of financial stability and default risk when analyzing the impact of commodity price fluctuations. Wow. So that is a long shot to study about things. Next topic is about natural disasters, public attention and changes in capital structure, international evidence. So this study is exploring an intriguing relationship between public attention to natural disasters and corporate financing decisions, revealing nuanced insights about how firms navigate external financing crisis situations. So basically, public attention and financing choices. Increased public attention following a severe natural disaster correlates with a higher likelihood of firms using a mix of debt and equity financing. Conversely, lower public attention tends to push firms towards relying solely on either debt or equity financing, supporting the harmful view. Impact of disaster intensity. The moderating effect of public attention varies based on the type of natural disaster and the source of online information, indicating that context matters. Small firms and financing. Smaller firms, which often struggle to access external financing, can particularly benefit from heightened public attention when seeking debt financing. However, this benefit diminishes for equity financing, suggesting that public perception plays a different role in each financing avenue. Internal versus external funding. The choice to substitute internal funding for external financing after disaster is influenced by the level of public attention, further emphasizing the importance of public perception in corporate financial strategy. Implications. Your findings suggest that public perception can significantly shape Public financing behavior in crisis situations. This underscores the potential for firms to leverage public interest and attention to improve their financial standing during challenging times, particularly in the context of natural disasters. This research could be particularly relevant for policymakers, investors, and corporate strategists looking to understand the broader implications of public attention in financial decision-making processes. If you have specific areas you'd like to delve into further, just let me know. All right. Didn't knew this kind of studies existed. So the next thing of topic that we are studying is actually talking about welfare and bank risk taking. Wow. So this studies all insight into the relationship between banking competition, risk taking, overall welfare, and a general equilibrium framework, particularly regarding moral hazard and incentive mechanisms. So these are the key takeaways. So maximal welfare and risk. In a perfectly competitive deposit market, the model indicates that banks achieve maximal welfare while maintaining an optimal level of failure risk. This suggests that competition can lead to efficient outcomes even in the presence of moral hazard. So comparison with monopoly banks, interestingly, the model shows that competitive banks can have a higher risk of failure than monopoly banks, yet still achieve better welfare outcomes. This challenges the conventional view that lower competition inherently leads to greater stability. Independence from social cost. The results indicate that social costs associated with bank failures do not alter the positive welfare outcomes of a competitive bank, and this highlights the resilience of competitive markets in managing risk without sacrificing stability. No trade-off between competition and stability. The findings support the conclusion that there is no inherent trade-off between banking competition and financial stability, which is a significant implication for regulatory policies and banking practices. Support for existing literature. Your results align with the empirical findings of Carlson, Correa, and Luck, reinforcing the validity of the model and its implications for understanding banking dynamics. Implications. These insights could influence policymakers and regulators, suggesting that promoting competition in the banking sector may enhance welfare without compromising financial stability. The model also opens avenues for further exploration of incentive structures and their impact on risk management in banking. So if you want to discuss further, feel free to ask ChatGPT. Wow, these are different kinds of things that we are studying. Okay, so the next thing that we are studying is asset pricing and hedging in financial markets with fixed and proportional transaction cost. Let's understand in detail what this says. It says we establish the asset pricing and hedging principle in a financial market model, which is a specific case of non-Newman Gale dynamical system with both fixed and promotional transaction cost and traditional uh, trading constraints. The main results are hedging criteria stated in terms of consistent valuation systems, generalizing the notion of an equivalent martingale measure. The study presents a sophisticated approach to asset pricing and hedging in the context of a financial market model that incorporates transaction cost and trading constraints. Now, asset pricing and hedging principle. The work establishes a principle for asset pricing and hedging within the model derived from the non-Newman Gale dynamical system and helps in understanding the dynamics of asset prices in the presence of transaction cost. Transaction cost and trading constraints. By considering both fixed and proportional transaction cost along with trading constraints, your model reflects more realistic market conditions, making the results applicable to real-world scenarios. Hedging criteria. So the main contributions are the hedging criteria expressed in terms of consistent valuation systems. This generalization extends the concept of an equivalent martingale measure, which is crucial in derivative pricing and risk management. Consistent valuation systems. The introduction of consistent valuation systems as a foundation for hedging offers a robust method for assessing the fair value of assets and liabilities, taking into account market imperfections. Implications. So these findings could significantly enhance the understanding of risk management strategies in financial markets, particularly under conditions where transition costs and constraints are present. This could also provide a more comprehensive framework for developing pricing models for derivatives and other financial instruments. Your work may serve as a valuable reference for researchers and practitioners aiming to navigate the complexities of asset pricing and hedging in imperfect markets. If you want to explore specific areas or implications of the findings further, just let me know. Okay, wow. So this was another complex topic that we finished. Next, this topic is talking about strict certainty, preference, and the predictive brain, a new perspective of financial innovations and their role in the real economy. Okay, let's see what this says. So this is offering a fascinating intersection between neuroscience and finance, particularly how the brain's predictive mechanisms can influence decision making in financial context. Here are the key insights and implications from your findings. Brain as a prediction engine. The dominant paradigm posits that the brain functions primarily as a prediction engine. Generally, predictions are then evaluated against incoming information. This framework highlights the importance of error signals in guiding cognitive processes. Resource allocation. The finite resources of the brain are allocated based on the relative value of error signals, prioritizing those with higher perceived value. This selective processing can significantly impact decision making, especially in complex environments. Certainty preference. The findings suggest that the brain's processing mechanisms can lead to a strict certainty preference where certain outcomes are favored over uncertain ones. This can alter cost benefit analysis, influencing how risks are perceived and managed. The implications for financial innovations are the perspective gained from neuroscience can shed light on the potential pitfalls of financial innovations like securitization, interest rate swaps, and credit default swaps. While these instruments are designed to optimize resource allocation, they can inadvertently lead to a misallocation towards low net present value projects due to the brain's presence for certainty. And these are the implications. So, this research provides a novel lens through which to view financial decision making, emphasizing that cognitive biases and neural processing can lead to resource misallocation in financial markets. So, this insight could inform better regulatory practices and financial strategies, highlighting the need to consider psychological and neurological factors in economic models. This interdisciplinary approach could foster new discussions on how cognitive science can enhance our understanding of financial behaviors and innovations. So this is the kind of thing that we are talking about. All right. I hope you all guys are liking this. Otherwise, there is just no use to go forward with the things. The next topic that we're studying is the valuation of corporations, a derivative pricing perspective. So basically, this is basically presenting an innovative approach to modeling corporations as entities holding a perpetual derivative security linked to future cash flows with significant implications for corporate valuation and risk management. Here are the key aspects and insights. So corporate valuation function. The value for corporation is characterized by a deterministic function of state variables known as the corporate valuation function. This function addresses the complexities of future cash flows governed by deterministic functions of state variables. Integral differential equation. The corporate valuation function solves an integral differential equation with the boundary condition of 0 at infinity, providing a rigorous mathematical foundation for corporate valuation. Non-linearity and risk attitude. It is observed that for positive and bounded cash flow functions, the valuation functions cannot be linear. Non-linear plays a crucial role in determining a corporation's attitude toward risk, indicating that a corporation may exhibit risk-taking behavior in some scenarios while avoiding risk in others, especially in higher dimensions. New asset pricing equations. The valuation theory leads to the development of new asset pricing equations that derived asset variations from risk-neutral covariations. This marks a significant shift from traditional approaches that focus on mean returns and covariances, instead emphasizing instantaneous risk exposures. Dimensional analysis. The solutions are illustrated across 1, 2, and 10 dimensions, providing insights into how complexity increases with dimensionality affecting corporate risk behavior. What are the implications? Your work contributes to a deeper understanding of corporate finance by highlighting how cash flow structures and risk perceptions interact in a multidimensional space. This perspective can influence how corporations assess risk and opportunities, potentially reshaping financial strategies and asset pricing models. Moreover, the insights into risk behavior could be valuable for investors and financial analysts, offering a new lens for evaluating corporate performance and stability. So this is the first topic where they're talking about how derivative pricing perspective can be help in the valuation corporations. Like when we are studying the valuations, it's talking about that thing. Next topic that we're going to study about is the optimal financing of a conglomerate firm with hidden information and costly state verification. So this is tackling an important aspect of financing decisions for conglomerate firms, focusing on the optimal financing method, joint versus separate financing. When the framework of costly state verification, here are the key takeaways and implications from your research. So optimal financing choice. The study identifies the conditions under which joint financing is more efficient than separate financing. This efficiency is evaluated based on expected audit costs and credit rationing. Joint financing advantages. Joint financing with return pooling between high and low states is shown to be more efficient. This arrangement reduces expected audit costs for the lender and can lead to less credit rationing for the borrower when investment costs are not excessively high. Separate financing benefits. In contrast, joint financing with return pooling between intermediate and low states is less efficient, resulting in higher expected audit costs and potential credit rationing, particularly when investment costs are high. Optimization methodology. The research employs an optimization framework to analyze the borrower's expected utility while considering incentive constraints and the lender's participation constraint, providing a comprehensive analytical approach to financing decisions. Your findings have significant implications for financial managers and conglomerate firms, particularly in choosing between joint and separate financing strategies. Understanding the conditions that favor one method over the other and can lead to more informed decision making, potentially enhancing capital allocation efficiency. Additionally, this research contributes to the literature on financing structure by clarifying how the interaction between project returns and financing methods affect audit costs and credit availability. It may also provide insights for policymakers aiming to facilitate better financing conditions for firms, particularly in managing the trade-offs between audit cost and credit rationing. If you have specific areas you'd like to delve into further, you should ask ChatGPT. Wow. So this is the kind of thing that people are researching about. All right. Hmm. The next topic that we're studying about is uncertainty in firm valuation and a cross-sectional misvaluation measure. So this topic talks about introduction of compelling approach to company valuation by integrating uncertainty into the analysis, significantly enhancing the traditional discount cash flow model. Here are the key elements and implications of your methodology. Probability distribution of fair values. Instead of providing a single point estimate for a company's value, your methodology offers a probability distribution that captures both the expected value and the intrinsic uncertainty associated with it. This richer representation helps stakeholders better understand potential risk and rewards. Econometric model for revenues. The approach relies on a robust econometric model to estimate company revenues, ensuring that projections are grounded in historical data and reflect firm-specific characteristics. Firm-specific balance sheet relations. By incorporating firm-specific balance sheet relations, your methodology tailors the valuation process to the unique financial structure of each company, improving the accuracy of the fair value distribution. Key finding, predictive power. The fair value distribution derived from a methodology proves to be a reliable predictor of future abnormal returns at the firm level. This suggests that incorporating uncertainty enhances the relevance of valuation for investment decisions. Long-short valuation factor. The creation of a long-short valuation factor based on buy-sell recommendations derived from the fair value distribution reveals information that traditional market factors do not capture. This factor significantly boosts the explanatory and predictive power of factor models, offering new insights into portfolio management. This methodology represents a significant advancement in valuation analysis, providing investors and analysts with a more nuanced understanding of company value that incorporates uncertainty. So this approach could lead to more informed investment decisions and improved risk management strategies. Furthermore, the development of the LSV factor may enhance asset pricing models, helping investors identify mispriced securities and optimize portfolio returns. So research could also prompt a revaluation of existing valuation practices in both academic and professional settings. So this is the kind of thing that they're talking about when they're talking about the topic of uncertainty in firm valuation, cross-sectional misvaluation measure. So the next topic is the market value of SMEs, a comparative study between private and listed firms and alternative stock markets. So this is the study about market value of private firms compared to publicly listed SMEs in Spain, utilizing a private discount approach alongside DSF in comparable multiples method. So here's the key takeaways: comparison of valuation approaches. The study employs both DSF projections and a multiples approach, including valuation, earnings, book value, and revenue, to assess the market values of private and publicly listed firms, providing a comprehensive evaluation framework. Absence of private discounts. Contrary to expectations, the results indicate no significant private discount. Is instead, some valuation ratios suggest a premium for private firms over their public counterparts. This challenges the conventional view that private companies generally trade at a discount due to lack of marketability and transparency. Mixed outcomes on multiples. While some multiples indicate a premium for private firms, others suggest a discount, illustrating the complexity of valuing private versus public companies and highlighting the variability in market perceptions. Limitations of private discounts. The study demonstrates that private discounts do not hold consistent comparative value within the same country, even though all firms operate in the same currency, suggesting that factors influencing private valuations may be more nuanced than previously understood. Next is the sensitivity testing of CAPM. By using a discount rate derived from the capital asset pricing model, the study also provides a sensitivity analysis of CAPM-based approaches concerning equity risk premium, terminal value, and growth rates, contributing to the discussion on the robustness of CAPM in different contexts. Implications: valuation practices. Your findings have significant implications for investors, financial, and policymakers. Valuation practices. The absence of consistent private discounts suggests that valuation practices may need to be adjusted, especially for private firms, emphasizing the importance of context and specific financial metrics. Investment decisions. Investors may reconsider their strategies regarding private versus public firms, recognizing that private firms might offer premiums under certain conditions, which could influence investment portfolios. So, market understanding. This is actually enhancing the understanding of the Spanish market, indicating that factors influencing firm valuations can differ significantly from broader market assumptions. The mixed outcomes on multiples could open avenues for further research to explore the underlying reasons for discrepancies in valuations and how market perceptions vary across different types of firms. So this is the type of thing that we are talking about. All right. So the next topic that we're talking about is actually delta hedging fractional volatility models. Delta hedging in fractional volatility models. All right. So this paper is kind of intriguing, like a delta hedging strategy within the framework of a long memory stochastic volatility model, specifically addressing how volatility driven by a fractional Ornstein Ullenbeck process impacts hedging dynamics. Here are the key elements and implications of a final key element. Long memory stochastic volatility model. This model incorporates long memory characteristics of fractional Ornstein-Ullenbeck process, capturing the persistent nature of volatility in financial markets. Delta hedging strategy. You propose a delta hedging strategy that adjusts for the specific dynamics introduced by the LMSV model, allowing for more accurate risk management when trading European type options. Hedging bias. The concept of hedging bias is central to your analysis, defined as the difference between the traditional Black-Scholes delta and the delta derived from the LMSV model. So by examining this bias, you provide insights into how long memory influences hedging effectiveness, conditions for over-hedging and under-hedging. So your study determines conditions under which a European option is considered over-hedged or under-hedged, depending on the long memory parameter H. This is crucial for practitioners to adjust their hedging strategy appropriately based on market conditions. So implications: enhanced hedging practices. Your findings could lead to improved hedging practices in environments characterized by long memory effects, offering traders and risk managers a more robust framework for managing volatility risk. Practical applications. The results can be particularly useful for financial institutions and hedge funds that deal with options pricing and risk management in markets exhibiting persistent volatility patterns. Theoretical contributions. By bridging the gap between traditional models and those incorporating long memory, your work contributes to the broader literature on stochastic volatility and option pricing, inviting further research into similar models. Risk assessment. Understanding the conditions that lead to over or under hedging can help investors make more informed decisions about their risk exposure, enhancing portfolio management strategies. This was the another topic talking about the hedging and various kinds of different things, and this was way past. So I hope this, so I hope guys, like this stream has given you like a good amount of understanding of like complex financial topics, the core terms, like where you can like you can kind of understand where you stand on the terms of literature, because finance literature is really complex, and understanding these complex terms is really necessary to move forward. And I hope my stream has helped you. Goodbye, and I'll see you again.